Welcome back, everybody. Thank you so much for joining me again on our monthly topic discussion. This month is February, and this month's topic is maximizing your individual retirement account. I'd like to accomplish giving you some insights on how to really take advantage of the major benefits that come along with using both a pre-tax and an after-tax IRA. So to sum it up, what an IRA allows someone to do is invest money in a tax-sheltered vehicle that is designated for retirement and grows over time. So we're looking for long-term growth and retirement dollars to use way down the line. That being said, there's really no restrictions on what you can invest in. For example, individual stocks, mutual funds, exchange traded funds, just to name a few, are some products that you can actually use within the IRA. Major advantages of using both a pre-tax or an after-tax IRA are going to be one, flexibility. You can put the money away basically as often or not as often as you like, monthly, quarterly, semi-annually, annually, or anywhere in between basis. It can come directly out of your checking or savings account. It's something that you don't even really need to think about, so there's a major convenience factor there. You can also write a check at the end of the year, so to speak, provided that you haven't hit the maximum contribution limitation, which is $5,500 before 50, and then if you're 50 or older, it's $6,500. Tax benefits. Major tax benefits come along with utilizing both a pre-tax or after-tax IRA. With a traditional or pre-tax IRA, you get an immediate deduction in the amount of the contribution that you make in the year that it was given. This money grows tax deferred, taken out age 59 and a half or beyond, and that's when you'll actually be taxed. With an after-tax IRA or a Roth IRA, the money is put in with after-tax dollars, therefore it grows tax-free, taken out tax-free. So two very different types of IRAs, however, both provide their own tax benefits either now or later. It's really up to you what you'd like to choose. Diversification as well as consolidation are major benefits. From a diversification standpoint, let's say you're putting money into a pre-tax plan at work. Well, those are pre-tax dollars, so similar to a traditional IRA, when you retire and you take that money out, that's when you'll be taxed. So you can actually open up a Roth IRA and take after-tax dollars and invest it into a Roth IRA, therefore growing tax-free, taking out tax-free, so that when you retire, you're actually going to have two separate buckets of money, one of which is going to be taxable and one of which is going to be non-taxable because it's in that Roth plan. A second diversification standpoint is you're going to be limited, most of the time I should say, in a retirement plan at work in what you can actually invest in. So you can open up an IRA or a Roth IRA and invest in different investments or products so that you're really diversifying your portfolio. From a consolidation standpoint, if you transition employers, if you retire, if your company downsizes, you're typically going to be able to roll the money into your own personal IRA, or you can put it into your new company retirement plan, but sometimes it makes sense to roll it into your IRA because you're going to A, keep up with that diversification, provide more flexibility, as well as looking at some major benefits and decreasing costs, potentially. Legacy is another one that I like to discuss. So with an IRA, as with any retirement plan, you can actually designate beneficiaries, and you can designate primary or secondary beneficiaries. And what that means is, in the event of your passing or something tragic happens, your loved ones are going to be taken care of, where the money will be directly distributed to them. There's no legal proceedings in order for that to happen. So again, whoever you designate as a beneficiary is very important because it's going to go directly to that person and it's going to avoid probate. So it really avoids some of the legal complications that come along with death or estate planning. Access to the money is 100% yours, of course. You're always going to have access to it. While there's no loan feature, you can sometimes take out the money prior to age 59 and a half, which is the retirement age, without incurring some sort of major penalty in taxes. These circumstances are pretty strict and rigid, but in the event of death or permanent disability, higher education expenses, meaning college or some post-high school education expenses, you have a limitation, but you can take it out for your first-time home buyer purchase. That limitation is $10,000. You can pay for premiums for health insurance if you're unemployed, and you can also take it out if your medical expenses in any given year are above 10% of your adjusted gross income. So those are the major advantages of using both a pre-tax or after-tax IRA. That'll fit more into anybody's own personal situation. That's certainly something we can discuss or answer questions on. Just to cover a couple drawbacks of using an IRA, one of which is the penalties for taking the money out prior to retirement age, which is age 59 and a half. This is really like any other retirement plan, but if you take it out prior to age 59 and a half, you're going to get penalized and you're going to pay taxes on the money. So with a pre-tax IRA, you're going to get a 10% penalty on the distribution in addition to being taxed at ordinary income tax rates. So just assume that any money you're taking out, you're going to lose a third to taxes and penalties. That's pretty significant, which is why I want to emphasize you really want to make sure this money is designated for retirement. Number two, with a Roth plan, because it's after-tax dollars, you still get the 10% penalty, but you're only taxed on the gain that you've made. So the taxes will depend on how much you take out of your Roth plan. There are contribution limitations. This is a major drawback as well of using both a pre-tax or an after-tax IRA. The maximum amount that you're allowed to contribute in any given year, if you're under 50, is $5,500. This is subject to change, and these limits are actually for 2013 and 2014, but they could increase later on in the future. So if you're over 50, it's $6,500, which is your maximum annual contribution. You also have to have the earned income that you're putting away for the year. So if you make $3,000, you can't put away $5,000 into an IRA or a Roth IRA. Similar to a Roth plan, you're going to be limited in the amount of money that you can actually put away if you're making a certain amount of income. So with a pre-tax IRA, there's no income limitations, but you have to be under 70.5 and have earned income for the year. If you want to put away for a Roth plan and you're a single filer, you're going to be what's called phased out, meaning that you're no longer going to become eligible in order to make contributions to the Roth plan. The phase out limits is between $114,000 and $129,000, and if you're married filing jointly, if you're making between $181,000 and $191,000, you're actually going to be phased out as well. So I would suggest that if you haven't taken advantage of the Roth and you're under those limits, but you think you're going to hit that soon, it might make sense to look into using your Roth plan if it fits into your personal situation and you can afford to put money away into it. And again, that's certainly something that we can answer questions on and help you with. So we've really covered quite a bit of information, and that's really the overview. As you get more in depth into your own individual financial picture, there may be more benefits to actually use the IRA and why we'd want to use it, but it's definitely a great diversifier, and it really adds a core piece to your portfolio, and it's good to have on the outside of a retirement plan, because really for that diversification factor, both where the plan is, where your assets are, tax-wise, as well as investments. So thank you so much again for joining me today. Really appreciate it. If you have any questions, there's a number and email at the bottom of the screen. Please feel free to reach out. I look forward to hearing from you and seeing you next month, and have a great day.